Hello, everyone, and thank you for joining us. Will, thanks for joining us. We're going to start doing more videos in 2026. It's a goal of ours. I think we provide, some good information, some good education, good context, speak a little bit more around events that are happening and try to be more real time with some of our content and education. But I think for me, Will, I think the importance of us being on screen more and talking is, and we talk a lot about this in the office, is it's been a pretty good ride for 5 years now. And I think that a lot of things surrounding money have been easy. And that's not always going to be the case. So the more we can be on here talking about important things will hopefully, help people when things maybe don't seem so easy here over the next few years. And that's not a call for a recession or a market crash or anything. It's just been, I think, easier to build wealth, grow your incomes over the last 5 years than it historically has been. And we know that free ride will stop. So I appreciate you joining us, Will. And we're going to jump right into a few topics here today. The first one we're going to talk about is hindsight bias. And, this kind of is a good segue because of how easy things have been over the last 5 years. So the definition of hindsight bias is a psychological phenomenon where individuals believe they accurately predicted an event after it occurred, often leading to overconfidence in their predictive abilities. So obviously you can see this in just everyday life. Oh, a 30% chance of snow. You don't take your snow boots and then it snows and then you say, oh, I knew it was going to snow, or certainly in finance. So what do you think when you think of hindsight bias, maybe more specifically in finance or even a personal life?
Yeah. The first thing that comes to mind is, stock picking, especially as you alluded to over the last, 10, 15 years. People definitely like to project their wins and not talk about their losses as much. There's been probably a lot more wins than losses from the stock picking arena here lately. But that overconfidence, especially as of late, can lead to poor decision making in the future, especially for retail investors that don't have the time or potentially the expertise to dig into these companies that they are investing in at a level that would allow them to, confidently and realistically make good decisions moving forward. So it's good to keep in mind that, just because you're right once doesn't mean you're going to be right again. Doesn't mean that it was completely your intuition or your genius, that had you thinking that you picked the correct stock and then it went up a lot. And now you say, oh, looking back in hindsight, I obviously knew that was going to happen because, I'm this great stock picker and so good at what I'm doing here. So understanding that is a bias that could get in the way can help you understand that it may have been forces outside of your control that led to this good outcome or to this poor outcome in the event that it maybe didn't do so well. So it's important to, with these biases, just recognize that they're out there, understand that it is a part of psychology, that it's kind of subconscious in a way that you're not really understanding what's going on behind the scenes. But if you bring that subconscious bias forward, you can realize, hey, maybe it wasn't just simply my great idea that helped this decision become great. And ultimately, that ties back into understanding the risks of investing or making these decisions that have large positive or negative impacts on your future self, and understanding that this is something to take very, very seriously, especially when it comes to money or really any big decision like this. So overconfidence bias is a good thing to keep in mind, and to understand that, just because something happened good in the past doesn't mean it may continue to happen good in the future. So you need kind of an overarching plan, not only when it comes to investing, but also when it comes to big financial decisions as well. And that's why it helps to kind of have a team behind you so that you can bounce ideas off of, or at least get a second opinion on, rather than just saying, hey, this is my doing and I'm the greatest investor in the world moving forward. So
certainly. I see that like gold, has obviously gone up a lot, and I've been hearing and seeing, I knew gold was going to do that, because gold hadn't gone anywhere, for a decade or more. And then all of a sudden it's made this huge run. And, you hear people say, well, I knew gold was going to go up. If you actually knew gold was going to go up, you would have bought a bunch of it, you know? So it's a simple question when you hear that is, well, how much of it did you buy then? And, oh, well, nothing. Well, then you didn't know, because if you knew beyond a shadow of a doubt, you had to put your money, a lot of your money or all of it, into gold. And so you didn't probably know that was going to happen. So I think psychologically, it's, it's hindsight bias, the ability to, like, because we want to be right, like that feels good. And so it kind of rewrites history in your brain and makes you feel smart and accomplished, in control, right? Because if you tell yourself you knew that, then you feel in control. And we love to feel in control, especially of our money, when in reality, yeah, we probably have a lot less control than you think. So good stuff there. Somewhere where we do see, hindsight bias a little bit and looking back and go, wow, I knew that wasn't maybe the best choice, is when we talk to clients about annuities. And, this is just, we think they have a place in the market. We think they're overused. And I'll say, I think they have a place in the market. I think they're overused. I'll take your opinion too, Will. I think they're way overused. I think most people do not need this to achieve what they're trying to achieve with their wealth. But, we've seen this a few times over the last several years as we've grown and are working with more clients that are coming to us with investments or things they've purchased through other teams or advisors. And annuities is just one of those. Every single time, it seems like, I think every single time we sit down with someone to look at their annuity and start explaining to them what they have, what it's doing for them, how much it costs, right? What are the pros and cons? We get some of that, oh, I knew that was a bad decision, kind of hindsight bias.
Yeah, definitely have ran into a lot of those situations in the past. And the reasons for those is a lot of, lack of understanding in the annuity sales process. Not that these advisors or these teams didn't explain them properly, but just that they are very expensive not expensive, very complex products. A lot of moving parts.
They're also very expensive. Well, you can say that. It's okay.
True, they are, but they are very, very complex in nature as far as what these moving parts are, what the underlying fees really are, how much you are actually paying to hold this investment product, this insurance product technically. And we've listed those out here for you on the screen. You can see the kind of national averages, commissions, either 1% to 8% of total sales price, which can be a lot. Administrative fees underlying in the annuity, typically around 0.3%. If you want to get out of the annuity early, surrender charges, as high as 10% in some cases. Expense ratios up to 3%, and I think I've even seen a little higher those expense ratios at some point in time. So those are what it costs on a yearly annual basis just to hold the investments and the annuity as a whole. That expense ratio, that's 3% of gains, right? Of your gains that you're giving up by holding this annuity product, which if the benefits are in relation to that value, right, that expense that you're paying, could be okay. But a lot of individuals just do not understand that those expenses are that high. And those expense ratios are not, that's a standalone expense ratio on top of all these other expenses that we have just discussed. And then some additional riders that you have on the product can increase those expenses as well. So there's some annuities where you could be paying all in 5% a year, right? In all in expenses, which when you look at the average of, the S&P 500, which is a typical holding that's held underlying in these annuities, the average return is about 10.5% a year. So you're giving up almost half of your returns each year for the benefit of the annuity, which could
be able to for the person on the other side, that's to label the word guaranteed, right? To be able to put these words on there, to use these in these sales cycles that feel good to the client, right? Mm-hmm. Downside protection, guarantees, right? We use investments like that don't come with all of these high fees and commissions and contracts that we're signing and things like that. So definitely.
Yeah, definitely good. Another thing that some clients don't understand that is really important to understand from a tax perspective is these bullets 2 and 3 here. So number 2, earned income versus capital gains. So when you pull money out of an annuity, you're actually paying earned income tax on those profits or that money that you pull out of this annuity. Typically, those are a lot higher than the traditional capital gains rates that you would be subject to just simply by investing in exchange traded funds or any stock funds that we may have you invested in.
Isn't the capital gains tax rate, like for married filings, only around 90,000? Like there's no capital gains on the first 90,000. I think that's the 2026 number.
Yeah.
Versus, correct me if I'm wrong, if someone just pulls out 20 grand out of an annuity, like it's earned income.
Yeah. So there would be, you would take that earned income, and then anything above your standard deduction, right, would automatically start to be getting taxed at 10%. And then as you climb the ladder, most retirees that we see are typically in, a 22% ordinary income tax bracket, just to kind of fund the lifestyle that they are wanting to live in retirement. So that's a big detriment to being in this annuity if it doesn't fit your overall plan, right? And then number 3 is very important as well. No tax loss harvesting inside the annuity. So if your investments don't perform well, and we do have a market drawdown, if you're holding these investments outside of the annuity, you can sell those investments and write those off on your tax return. Versus in the annuity, you just kind of have to hold on to those investments, see the value come down, and then not really be able to execute anything that's beneficial from a tax perspective there. So overall,
go ahead. Sorry.
Overall, I just would say annuities do potentially have their place in some financial plans. I do think I agree with you, Shean. They're overused. They're sold quite a bit more than maybe the clients need and in those right scenarios. So it's just important to understand exactly what you're invested in every time you make an investment decision, especially when it's something that comes with a contract associated with it, like an annuity.
Yeah, I think looking at what we have on the screen and hearing you talk, the word that kept coming back to mind was control. And when you do something like this, you lose control. And having the most control over your money is probably the most important thing. And when you buy that annuity and you're holding it long term, you lose control on your taxes, when you want to pay and how much you want to pay. You lose control on tax loss harvesting, being able to take advantage of, circumstances that come your way as the market, goes up and down. You've lost control of what the whole goal was to have, is that financial freedom, financial flexibility, and control over your money. You're losing that control. So, yep, I think that's really good points. So anyway, hindsight bias, we see it a lot. We see it in everyday life. We see it a ton in finances, and just we ran into some annuities over the last several months that really felt like people knew what they were going to be and they just didn't quite know. And again, that's not their fault, right? We should be trusting the people who are wearing the sport coats in the meetings, and those are the folks that should be out there doing what's best for everybody. So you can't blame yourself, but yeah, just take your time when you get into these conversations and make sure you fully understand what you're purchasing and what things look like 3, 5, 7, and even 10 years down the road. So Will, appreciate you taking the time. Everyone, we appreciate you joining us. As mentioned, we're going to try to, get more content out to you, specific top of mind things. We'd love for you to comment or send us a message on anything you'd like to hear us talk about. We'd be happy to put that in the rotation. So again, appreciate your time and hope you all have a great rest of your week.